Well, welcome back, Peter Daneyko with Core Connects, and we're on their next hour on from our Real Estate and Jobs Act and Tokenization and Liquidity Summit, focused on real estate. Uh, my panel and my co-host here today is Ryan Frank, um, and I want to welcome Ryan here. And we're going to be talking about RegD and RegS and all things RegD, RegS, focused on the marketing side of it. Ryan's expertise with his firm for the last at Funded Capital, the last decade or so, gives Ryan the ability to give us some great insights when it comes to RegDs and RegSs, and specifically from a marketing perspective. So, Ryan, welcome.
Thank you so much for having me, Peter. Yeah, look forward to jumping in, and maybe I'll let you kind of set the table, and we can kind of bring people through some of the basics and get into some of the nitty gritty.
Yeah, let's start with the discussion on the definitions of Reg D and Reg S. A lot of our audience might have been in earlier panels and might have heard some of this information, but for our new audiences, Regulation D. I mean, it was an offshoot. It also came with Reg CF and Reg A during the Jobs Act 11 years ago, but it was focused entirely on a different audience. Maybe I'll turn it over to you, Ryan, and you want to, and collectively we can have that discussion.
Yeah. So I'll split Reg D really into two broader categories that we tend to see, and we'll really focus in on one. So when you hear the term 506 or a Reg D 506B versus a Reg D 506C, that's something you'll hear thrown around. The Reg D 506B, which we won't focus too much on here, but that allows issuers to go and target U.S. accredited investors, but there's no general solicitation in a 506B. So really, issuers are using that within their own network to bring in, contacts of the business, their own network, things like that. Whereas when you flip over to Reg D 506C, that's where you can do the same, but also do general solicitation and marketing for your raise. So certainly, I think for today's focus, we'll be keying in on the 506C for the most part.
Without question. So the key thing is I'm doing a 506C if I want to market my offering to my existing shareholders, and I want to put it out there out there to the public for those accredited investors as well. And a 506B, I have my network as ready, and I'm just doing the proper filings with the SEC, allowing me to basically to submit my offering. So I'm going after accredited investors only. I'm going after a Reg D. It's U.S. investors. Let's talk a little bit about some of the marketing structure that you set from a foundational perspective when you're going to do that.
Yeah, absolutely. So when we're talking, Reg D, and I'll maybe compare this on some of the previous sessions where conversations were surrounding maybe Reg A or even Reg CF. Reg D, you've got a bit of a different flow. While when at the end of the day, you're still sending traffic from, advertising and things like that. I'm sure we'll dig into that more to ultimately an offering page, that offering page tying in with, for example, Core Connects and people being to invest right there. The big difference when you're going after accreds, and typically with that, you've got a higher minimum investment. We can kind of dig into that a little bit as well. But one thing I'll throw out of the gates, certainly you're targeting a different audience. We'll dig into that. But your whole kind of investor funnel and flow has to change a little bit. And when you think about it, the amount of people, accredited investors in the U.S. that are going to come in, see an advertisement, and start that investment process right away, it's going to be very few, right? So typically what we're doing is we're trying to drive somebody to an offering page, collect a lead. For example, as opposed to getting too aggressive and trying to push them into the investment flow, let's get their name, email, phone number, for example, and then they can download our investor presentation. So we'll kind of work through a variety of soft opt-ins there. You've got a much longer latency from the time someone shows interest, kind of you generate that lead of a prospective investor to the time somebody's going to invest. That's going to be a longer latency typically with an accredited investor, and a higher minimum investment in the offering. And then once you get that person into the funnel, I would say it's, the way I like to describe it to issuers is this is a, 50% marketing, 50% investor relations effort at that point, right?
Okay.
Accredited investors, they're going to want to talk to somebody at the company. They're really going to want to get comfortable before they're, going to put in 10, 25, 50, $100,000, what have you. So it's a little bit of a different process, and it requires a lot more, I would say, nurturing and kind of one-on-one outreach than maybe a Reg A or a Reg CF.
So I think one of the common denominators between all the exemptions, though, is I need to communicate with that investor. I may communicate with them slightly differently, but I have to earn the right.
Yep.
I can't. I always like to come back to the cliche. I can't put that ring on that pretty girl's finger across the way without knowing her. I mean,
Yep.
throw it, and so we establish a relationship. You mentioned collect the leads, names, emails. Is there any categories or segments based on the raise? I'll call it industry specific in relationship to personas. If I'm doing a Reg A raise for the medical community, am I going after doctors, or does that accredited investor more looking after a broad range of investment opportunities? And we're focused on real estate here today, but is there any differentiators, in your strategy?
Yeah, so I would say yes. Like there are cases where so I'll throw it out this way. When we're targeting, I think there's a couple elements to it, right? So one, you're looking at accredited investors. Number one, I think the most recent data I saw, it's about, and this is post the SEC kind of updating their definition of a accredited investor. I believe that was in 2001, not too long ago, or 2021, not too long ago. But I believe it's like 9 or 10% of the US would be considered accredited. So right then and there, you've got to look at things like targeting on household income, net worth, things like that, because you really need to exclude, 90+% of the individuals in the US from that offering. I would say second, when you're working with the marketing partner, and actually, do you want to do a quick intro here?
Hey, welcome, Andrew Korn. Andrew is back with us from E5 AIM, and I'm glad to have you here to join Ryan Frank. And as you both spent a lot of time on the Reg D and the Reg S world, and I'm gonna go back to Ryan. Ryan's just given us a bit of a snapshot on some of the different audience segmentation and the targeting and what that audience looks like, and I want you guys both to bounce off different ideas and strategy and structure when you're going after a Reg D community. And then we're going to talk a little bit later on Reg S's. So Ryan, continue.
Yeah. So I was really just saying that when you're looking at a cred in the US, I mean, you really are targeting about 9-10% of people in the US once you look at who meets that definition of accredited investor. You deal with some challenges, like there are even accredited investors who aren't familiar with that term as well. So part of it is a bit of an education piece on explaining what that is and what the requirements are through the process. But I was saying, you're going after higher net. So you're looking at kind of targeting based on net worth, household income, some things like that typically are going to more align with investors. Typically, like when I look at our firm and really I would say any marketing firm in this game, typically you're leveraging a lot of existing audience data that you have, right? So if you've been doing this a while, you've got, a laundry list of accredited investors come into deals similar to probably your deal, right, at the end of the day. So using a lot of existing data from your marketing partner, lookalike audiences, if you have any, kind of investor base or small investor base in the company, kind of looking at and profiling off that. And really to answer Peter's question, on if it's a real estate deal, do they have to show interest in real estate? If it's a biotech, are you targeting doctors? That type of thing. Absolutely. If you can layer in, income, if you could layer in a profile of an accredited investor and then also tie in an interest into that particular offering, be it real estate, biotech, what have you, that's always a plus. But I think at the end of the day, too, we still see a lot of non-industry specific targets work well for these. So some accredited investors are going to be, investing across all sorts of different spaces. So we do a bit of both at the end of the day. We try to layer in accredited, kind of profile with the industry that's relevant to that particular issuer. But then also we just target accredited as well. It's usually a mix of both.
So what I'm hearing, I think, and I'm going to segue to Andrew here, is over the years, both your firms, you guys spent a lot of time nurturing and building an audience that you can repurpose on behalf of your clients going forward. Would that be correct, Andrew?
No, it would not. We never use data from one client to another client. It's an ever. All that data, in our view, is owned by the client. What we have invested a lot of time and effort in is building our own data that's exclusive to our agency, that's not going to be found on Facebook or through Google or any other major publisher. And it basically comes down to match rate. We have about 800,000 doctors and dentists, just to kind of play on what Ryan was saying. But that data is ours. That's not our clients.
Maybe
we use it on behalf of certain clients when that fit is right. Also, we don't use any lookalike audiences when doing RegD. We use lookalike audiences extensively in Reg A+. But even when I say extensively, we're using it at the thinnest possible places, meaning you can just do a full lookalike, or you can do 90%, 80%. We'll do 1 or 2%, maybe 3%, but even that's a big stretch. But for us also, especially in real estate, we will look to get our issuer on a custodial platform because we can identify every single financial advisor who has a custodial relationship with that platform. And then we can solicit them. They can then determine who is qualified for it. And a lot of the rules go away because the advisor is the one bringing in their clients. They'll frequently do an SPV. They'll put 10, 15 clients in it, and boom, they're in, and it's one very large allocation. Similarly, we'll go after endowments and foundations and public funds and occasionally Taft-Hartley if it makes sense. And again, we'll use different marketing techniques to get to them, and they're consultants. So, going after a family office is very different than going after an accredited investor. And then last is, what's the minimum investment? On a Reg D, it might be 50, it might be 100, it might be 250. Even at 100, you're not talking accredited investors anymore because, the definition is so low. Someone who's got $100,000 to put in a deal with people they've never met before, they need to be qualified. And I am a qualified investor. And I know what I put money in and what I don't put money in. And there are lots of people who don't think the way I do when it comes to investing, which is fine. So, like I said on our last session, you need to be prepared for all schools of thought.
So what I'm hearing from both of you is it sounds like even within the Reg D, an accredited investor is not the same based on the offering. Size of the offering is a big indicator. So maybe talk about that or share some types of offerings that you guys have worked with that says, okay, I'm working with something, a minimum offering of, I don't know, you guys can tell me of minimums. What are the minimums and what's a small Reg D, big Reg D? I'll turn over to you, Ryan, and give me some
I'll throw it out. And I think that interesting kind of last comment. I mean, you've got two firms here doing the same thing and probably taking slightly different approaches, which is very interesting. We do a lot with lookalike audiences, even on the Reg D side, and see success there. But it's interesting. There's no one path to get there. I'll throw out something more specific to kind of our strategy. Typically when we're going out and doing general solicitation, we want to see a minimum somewhere in the 10 to 25K range for a Reg D. And so we try to go honestly for a little bit of a smaller minimum. We find, and again, it's who you're looking at. Are you targeting individual accredited, family office, institutions? You can bring all of them in, but I'm kind of speaking more in the context here of an individual accredited for this purpose. So we like to not set that minimum too high. Once you get into, kind of to Andrew's point there, once you get into 50, 100, it becomes a little bit of a different animal. And typically what we find success with is let's get somebody who's interested, who's qualified. Maybe they're qualified to, or they have the money to invest way more than 10 or 25 grand, right? But they see the offering, they're interested. They think, hey, let me come. I'll put 10K in it and take a punt at it, right? Then they're on the list. And then really we segment out the list of who's invested from who are still prospects, and really focus in on those who invested to continue to tell the story and try to get them to add to the position. And we see that happen all the time. They come in small, they get on the list, they get some communication, they attend a webinar or what have you, and then they come in for a bigger amount. And so we kind of, we take that approach. And again, that's more specific to individual accrediteds.
And Andrew?
Yeah, so it has a lot to do with what the goal is. So I'm going to agree quite a bit with Ryan here but starting with, is it a $100 million raise or a $500 million raise? Because we'll approach them very differently. And we'll look at who the audience should be and why, because I agree, if you're going after, quote, smaller accredited investors, $10,000 is a good place to start. And then you can always raise the minimum later. But you do the math on that into 500 million, you're not going to get there, like, ever. So,
well, you're also going to cross over your 2,000 individual investor threshold, aren't you?
Yes, you absolutely will. So, each one of these things is a factor in what we're doing. And when I talked about quickly the SPV and getting a bunch of people to pool their money who may or may not know each other, but doing it through a financial advisor is a really good way to go. But then the issuer needs a custodial relationship with someone like a Fidelity, a Schwab, or an LPL. So we do a ton of marketing. My firm also markets ETFs and hedge funds and other things. As a former portfolio manager, I just know that world super well. So we'll look at it and, what does it take to get research written by a brokerage firm, et cetera, if you're already on their platform. So it's a whole different thing than doing advertising aimed at individuals. But you definitely want to push the demand into the person who would be making that decision or recommending it for their clients. And then moving up to institutions, same thing. You have to go after their consultants, not just after them. And those are much longer time frames. The bigger the check, the longer the relationship generally has to be. In February, we had a massive number of people reinvesting, some of them in the hundreds of dollars, some of them in the tens of thousands of dollars. And it's all good because the cost of acquisition was next to nothing on that new money because they were already in, playing on what Ryan was saying. So, every circumstance is unique. And then I want to toss in, are you in the summer? Are you in the fall? Are you in the winter? Because frankly, every 3 or 4 months since 2020, the market has changed, at least from our perspective. Every 3 to 6 months, we're looking at whatever we did needs to evolve or radically change. And 2022, we added more new tactics than any 3 years before that. So, it's just a very evolving world in what we do, which is one of the things that we thrive on. And I'm betting that Ryan and his team thrives on as well.
Yeah, and I would echo that. I would say we prior to 2020, we probably had more consistent ad spend throughout the year, and certainly that's changed, and it's more kind of hitting it when it's hot, pulling back when it's not, and really respecting that.
You guys both touched on seasonality. Oh, did I freeze?
You're back. We heard you.
There we go. You touched on seasonality. Is there times of year, better or worse, going into tax season, pre-December? Does that have any impact from the accredited investor on your RegDs?
Yeah, I'll say from my standpoint, it certainly does. And so, you've got the basics such as timing holidays and things like that, but also throw it out. This is, to kind of come back to the real estate focus. we find a lot of scenarios where, you know, let's say non-real estate deals where we're pulling back a little bit around the holidays and kind of saving that spend up for coming out of the holidays and the first of the new year. I tend to see in real estate deals, there's more money moving around at the end of the year. I don't know, Andrew, if that's something you've seen, but that's something we definitely noticed. We tend to pull back, I would say, a little less on real estate towards the end of the year than we would other types of deals.
So I'm going to agree with that. The cost per click goes up in December because, you know, you're competing with every holiday present out there. And then I'm going to share a personal thing. I have two daughters, and for the holiday season, I bought each of them shares in real estate through Reg A Plus. So, you know, an unusual holiday gift, perhaps, but one that will pay dividends for years, not just figuratively, but literally, and also hopefully teach them more about investing. So we saw this December some surges in real estate investing. And, you know, when you're looking at qualified opportunity zones versus not, you know, every day is IRA season, every day. It's come April 16, you're just in the next season. And I recently read an article on that's actually the day you should make your next IRA investment so that you're gaining even more time on it and getting more of the power of compounding over time. So, but getting back to the original thing, you know, around July 4th, we might pull back. But it's a test, measure, refine, optimize thing. If we see like this past December, normally we're just pulling back and we're going to take, you know, a week or so off. No, not this year. This year was incredible, and we did not see a pullback. So
it sounds like things are constantly changing. Types of marketing that both of your firms are doing. I have heard reference to click-through ads. I hear reference to social media ads, references to existing databases. All of the above. What are you pulling back from? What are you putting more energy into? Andrew, last conversation we had, you're talking about even TikTok was an interesting channel, which surprised me. I don't know if that affects the Reg D space as much as maybe the other spaces, but let's just go through kind of a list of the different marketing channels that both of you are using.
So this is going to sound odd, but we have found even professional investors that many of them are also people. And if they're people, odds are they have TikTok on their phone. And if not, they're looking at reels on Instagram and on Facebook and other places. So the concept of TikTok needs to be taken very seriously and embraced, even if you're not spending paid media dollars on TikTok, which we have not for a Reg D. But using the mindset of, you know, showing them a short piece to get them really interested so that they come in and do more diligence so that they can then make an investment, that's not gone away. But I also want to toss out that what we do for multifamily is different than hospitality, than is different for a medical REIT, which is different than self-storage or office space and, you know, single family homes for rent. They all need to be treated differently. And that has a lot to do with storytelling, media, buying, and who our audience is, because not all real estate is equal.
Well, let's explore that a bit, because I'm going to be somewhat naive from this perspective to say, okay, an accredited investor is somebody that qualifies, but you're going to market to those accredited investors differently between, like you said, multifamily, single family, medical REIT, real estate REIT. Expand on that a little bit.
Sure. So one of the big questions that we ask an issuer is, I invest on March 1st. When do I receive my first dividend? Let's say it's quarterly in a Reg D. So it's quarterly. Does that mean, okay, so March 1st, I have till the end of March, and then I've got the next quarter, I'm going to get something on July 1st. It'll be, well, we're not really ready, and you need, this really affects who you're going to market to, because depending upon age and where they are socioeconomically, because you read in the papers, people making $300,000 a year are living paycheck to paycheck. So they're just living it at a very different level than someone earning a tenth that. So, how fast are they going to start seeing income? We've had land deals where, the returns are going to be much higher, but there's absolutely no payout in the first 2 years. So, and they're longer deals. So all of those things make a difference to who we're going to go after based on what we think they're looking for.
Makes sense when you put it that way. Ryan, your take on that?
No, yeah, I would agree with that. I think, and I'll just kind of layer this onto it. It's a little bit easy, it's a little bit more straightforward if it's a real estate deal with dividends. But I would say, just generally speaking, we're trying to work on deals where there is that path, and there is timetables, like path to liquidity timetables. If it's dividends, they're on schedules, things like that. That is critical. And I would echo Andrew's statement to say that, yeah, somebody that's looking for an investment opportunity for quarterly dividends or something like that, versus somebody that's going to make maybe an equity investment in the company behind a fund, or just an equity investment in a company that might have a multi-year timeline to liquidity. It's going to be a different person often, right?
And that makes good sense. I mean, as far as the conversation goes, you just brought up funds, for example, on RegDs. Different investor, different type of appetite. I guess it depends on the nature of the fund. Maybe you guys can give me some insight on that.
Yeah, I'll throw out, so funds on a RegD standpoint become very challenging, because I think a lot of funds are held to a 99 investor limit. I think there's certain scenarios where that number can be 250, but when you're doing a RegD fund, that is an inherent challenge that you're up against with a lower investor count limitation. And there's different things you can do. Maybe that you're launching multiple funds, right? With slightly different portfolio mixes, slightly different strategies, and then you can do multiple of them. But that becomes a real big challenge. And I don't know, Andrew, if there's any thoughts you have, but that's certainly something we run into. We've worked some scenarios like I just mentioned and kind of made things work oftentimes, but sometimes for RegD funds, that's a bit of a deal breaker, and kind of going the general solicitation route.
Yeah, so it all has to do with where are they going to max out and what's that going to look like. So that will then determine the audience also, because if you have a $10,000 minimum and it's a 2,000 person max, you're still only at 20 million. Might as well do a Reg A, and you can go to 75. So, and you can file for 75 and only raise 20 or raise 23, because with a little momentum, it just came in like that. So, getting in on the structure early, I think it's very important for issuers to talk to their marketing firm and really have them as a partner. It's really nice to hear the in-depth knowledge that Ryan has of the market and understanding these structures, because it's part of what a good marketing firm has to do. So, it's something that we are super involved with. And anyway, so the institutional route, when you're doing a $500 million or $1 billion raise, you're going more institution, but we've also done it through financial advisors. So, it's still basically a retail thing, but from a compliance standpoint, you're only soliciting advisors. So that's it.
When you're doing that,
minimal.
When you're doing that type of marketing, what is the approach in that? I mean, you're going after significant large dollars. You said you're not just going to the institution there. What's the approach on that? How do you tackle that? I mean, this isn't obviously emails and the web's a little bit differently. I mean, this is, there's
yes. And now you're talking about a group of people who are very hard to solicit. They don't click a lot of ads. They don't open emails from strangers. They don't have time for any of it. So we need to partner with an issuer who's got a good sales team. and understands this audience and how to speak to them. So we need to arm them and prep them if that we can get them in front of someone that they have a high probability of closing. So what we end up doing is that we use a lot of different tools and tactics to measure behavior. So we will not have 5,000 financial advisors pick up the phone and call the issuer and say, hey, send one of your salespeople over because we're really interested. We want to gather a ton of our clients together and pool their assets and be, one slot on your cap table. It doesn't work like that. Although some will, which is kind of shocking to me, but some will. But we can, out of the 200,000 advisors in this country who would be able to do that, we probably can identify 5,000 of them who have engaged in a manner with your very sophisticated campaign that we know they're truly thinking that they are interested in allocating. Same thing goes with pension consultants, and it's a very similar playbook, just extremely different content because they are operating at a totally different level. I write for wealthmanagement.com and Investment News, which are both aimed at advisors. And I've thought about, my firm designed Pension and Investment Age's website. So, we're really tied into these markets, but not every issuer is ready for them. I love it when someone calls me and I bought 10 buildings and turned them around. It was value add deals. They were multifamily. They were all really successful. And now they want to raise 200 million. It's like, no, because you've never actually done a fund. You don't have an audited track record in a multifaceted portfolio. It can't be done. Now, it can't be done with us. It can be done with someone else potentially, or they could do the hard groundwork themselves. So there's a lot of suitability to make sure that there's an audience fund or audience issuer fit.
I mean, you just hit on something, and I really appreciate the context that you had given there when it comes to what's a good fit for you. And I think any good agency and firm, you stay in your lanes to a degree, or you're focused on your specialty, so you're going to have the highest success factors. And nobody wants to work 90 hours a week just taking on business for the sake of taking on business. So I certainly appreciate that comment there. What do you guys not like to do in the Reg D space? This is more of a personal side of it in this session, but it gives some, I think, flavor to the audience. You said we do these kinds of Reg D. What do you never want to touch?
Yeah, I'll start here. So I think, for us looking at these, we kind of take this model. If we've got 10 or 20 issuers that reach out, it might be one or two to where when we have conversations with them, all the pieces are there. And I'll kind of go back to an example that Andrew mentioned there, the kind of sales / investor relations side of it. I'll use that term a little bit interchangeably. Even taking that away from, large advisors and things like that, even when you're working with an individual accredited, these issuers still have to have good sales / investor relations teams at the end of the day. And you run into a lot of compliance issues there. So it's knowing that balance of, as a marketing partner, and typically marketing partners are not going to be broker dealers as well, right? Coming into this, how far can you take that ball before you have to pass it off to usually somebody that is employed by the issuer that can have a conversation, convince somebody to invest, what have you, right? Working under the issuer exemption. So I'll just say for us, like, we create that whole kind of marketing and sales funnel tying into kind of the sales and IR funnel. A lot of that crosses over. And we do a lot of things that are, a lot of people look at, marketing emails and offerings like this, and they think, oh, we're sending emails out to prospects and investors. Absolutely. What about using those same emails internally? So, for example, you've got, somebody from your IR team as the issuer, or your, single person that you've assigned as heading up IR. They're trying to get a hot prospect on the phone. Maybe they had a good initial call and person sounded like they were going to invest, and that person ghosts them, right? And they're not hearing anything. Well, you can use your, marketing automation CRM platform to then tell you, hey, when did they click on one of our emails, or when did they visit our offering page? Because as soon as they do, let's fire a notification off to the head of IR or whoever was responsible for working that deal, and let them know they're engaged right now. Right now might be a good time to call them, right? So things like that. I went a little bit of a rabbit hole there, but IR becomes a challenge, and finding companies, at least from our perspective, finding companies that are able to manage and handle IR in a compliant manner can become difficult. And it's I always put it out up front. This is a big commitment you are signing up for as an issuer. This is not a small commitment. Either you're managing that internally, right, as the issuer, and that's typically where we see that working west. Technically, you could bring in a broker dealer. Most broker dealers don't want to be involved with that type of thing, right? That's just not up their wheelhouse. So I throw that out. That becomes a challenge. That usually I've seen that become a sticking point many times in deals, right, where that IR support doesn't meet the amount of lead flow coming in, or just what's needed.
Well, you hit on something that is so important from a compliance perspective. And what I'm hearing here is, and I know I'm going to hand this over to Andrew, because I know that I've seen Andrew do this, where some of his clients, it might not have been a RegA specific, but I've noticed on some offerings that are using our technology, and Andrew happens to be the guy behind making the raise happen, whereby the offering page or the landing page is saying you click on the invest button, but you got an option. Do you want to talk to somebody first? Is nurturing that client, and that individual must reside within the company. And I think that becomes absolutely critical here, because I want to ask the question of what some are saying is operations that are being somewhat untoward with call centers that aren't necessarily licensed to do so. Andrew, takeaway on that comment there?
Yeah. So first, I want to answer your first question, and all I'm going to do is point to Ryan and say what he said, because it looks like we've both been around the block and both have gotten some bumps and bruises. I'm just going to add to that is we only want issuers with the wherewithal for the long haul. It's a commitment both in time but also in money. We've had offerings which I have looked the client in the eye and said, I am more than just confident. I can't guarantee you anything, but I can tell you from my 6,223 years of doing this, that this is going to work. It just might take longer. And take longer also means more media dollars spent and more months paying us. And that's unfortunate. But at the end of the rainbow is not only bringing in all the cash, it's probably doing it at the cost of capital that we talked about in the very beginning. It just took longer for that tipping point to happen. And that's really hard for an issuer to swallow. So they need to be committed to, we're in this for the long haul, because the other big thing is that when we're done, that next day we're ready to do it again, but we're not starting at the beginning, we're starting already sprinting. And using that data all over and using everything we've learned about positioning and messaging and what is compelling and what is driving people, it's so exciting for us. And by then, with a good relationship, it's really exciting for the issuer as well. And then we can raise the bar and go for even more money the next time.
If you were to graph that out, because I've heard that comment a lot of going, okay, I'm starting this journey and it's 3 months in. Do you have any metrics or any data that says on average that says, okay, in a 12-month cycle, I'm going to get X% of my raise from month 6 to, is it an exponential component because of the early marketing efforts? And is there, to give comfort to that issuer that says, I'm 3 months in, looks like we got a lot of activity, we're following your nurturing mechanism, is it month 4? Is it month 5? Is there any algorithms that averages that?
We need to hold hands and have some faith at that point. And I have seen it take longer and shorter, and some of it was we really just nailed it on one item with an audience, a custom audience, or a specific message, or it was an event. Some of it is what's going on in the world, and it just made it so that took off, or it made it so it different. It didn't. I mean, in March 2020, no one was going to listen to anything dealing with equity crowdfunding. But by the end of June, it was like shooting fish in a barrel. And a year later, it wasn't. So many of these factors go in it. But when you have a good issuer so what we're looking for is an issuer when they've made a promise, we're going to give a preferred return of this. We hope to beat it. There's going to be growth on the back end. If we really believe and they believe they're going to do that, it's going to be a successful offering. It just might take longer, which means more upfront dollars before they've recouped the
So it's a partner.
It's a hard thing. This is extremely hard work, but it's not exponential. It's more geometric, and I describe it like a snowball. It's really small in the beginning. It's got to twirl an awful lot of times before it starts getting bigger. But once it's big, every time it rolls, it just took on an awful lot of snow, and the money comes in like that, which is why we love serial issuers. We're going to do it more than once because we've already killed ourselves as a team, the issuer and us, to get to the point where we have the whole snowball. Now let's make it a snowman.
I love the snowball analogy, and then each issuance is adding little balls to the top of it until you have a big base again. I like that. I like that a lot.
I'll throw out two real quick that trying to find some early wins to help weather some of those early storms. Let's try to focus on bringing in maybe there's some smaller accredited investors, things like that. But let's try to prove out the model that the lead quality is there, that we can convert them. It may not be what they want early on, but let's find some ways to have small wins and weather that storm through the early stages. And I might throw out too, more for Peter. I don't think we've said one thing about RegS, and we might be coming to closing.
I was just looking at a note. So one of the topics that we had was, okay, we've got a RegD. We know what it is. It's for that accredited investors up to 2,000 within the U.S. And then we have a RegS. From a technology perspective, we've done a number of where we're doing the invest tech for RegDs and RegSs simultaneously. There's some legal requirements and guidelines around those. I'm going to ask either one of you to jump in and maybe give me some of those from a marketing perspective and from a structure perspective, the good, the bad, the different, and what your experience with RegD and RegS is, perhaps from a definition on the RegS first.
Yeah. I'll throw out a quick... Go ahead, Andrew. You good? Go ahead.
No. You should go first.
Okay. I'll throw out one thing. So, and for everyone just kind of taking it. So typically you're seeing issuers pair a RegD 506C, general solution there, US accredited investors, with a RegS, which then allows you to bring in international investors. Those international investors, there are some legal considerations with which jurisdictions you're going after, and are there local, laws that they have that may, tie in here. But we'll take that out of the mix for a moment. We could go down a rabbit hole there. International investors certainly don't have to meet the US accredited definition, but when you're pairing a RegD RegS offering, typically your RegS offering is going to have the same terms often as your RegD. So you can't just go after anyone internationally, right? You've got to go after somebody internationally that's going to be able to at least meet the minimum investment and things like that. So you do have to be thinking, even though they don't have to meet accredited definition, you've got to be thinking in similar terms when you're targeting a lot of these folks, because you have to get folks with similar types of wealth level. And the only other thing I'll throw out, not to get into kind of a technical rabbit hole, but when you're executing a RegD and RegS, there's this very specific ways you need to do that. So for example, and again, I'll kind of go with more of the more conservative legal advice I've gotten on this, but you don't want a US accredited investor that's maybe looking at the RegD. You don't even want them to know a RegS exists. And so what you're talking about there is that you're leveraging a lot of the same assets, but you're running two separate campaigns in parallel. Typically, we're talking two versions of the offering page, two versions of pitch decks. Again, a lot of the content's the same, but it's really segmented. And then even from a portal standpoint, like KoreConnects, you've got to geo-block, people from one side being able to access the other. And so I just, not to go into too much of a rabbit hole, but I'll say this. I've seen a lot of people that really don't understand the compliance piece of running a RegD and RegS in parallel. I've seen large funding portals that don't understand it and couldn't support, things. Certainly, I'm not talking about CoreConnex, but I've just seen a lot of people that don't understand it. And I would say, if you, as an issuer, really make sure if you're running those in parallel that your marketing partner and the funding portal really understand how to execute RegD, RegS in parallel and understand the compliance considerations, because it'd be real easy for an issuer to go hire a marketing firm that doesn't understand that, and then you're doing a whole lot of stuff that is nowhere near compliant. So I'll shut up now, but that was just a little.
If I hear one more time, people go, Peter, we want to do this, whatever they want to do, because I see it over there. I mean, I don't have any hair as it is, but I pulled the last hair out. I go, just because they're doing it over there doesn't mean it's compliant. So I'll turn it over to you, Andrew.
Yeah, it's fascinating because we've been forced to even just block our sites from non-US traffic. And I've got an employee in Africa. I've got an employee in Dublin. And, it's like, oh, they can't see the live site. Well, that's a real difficult thing. And there's some intranet and FTP, and there's all sorts of ways of getting around that. But it's not just that you need to run them in parallel, but is the jurisdiction you're going after not just compliant, but do they speak English? Do you have to translate everything? And then do you need a broker dealer in that jurisdiction as well? So there's so many complexities to it. It's easy to take a single non-US resident into a RegD. But if you're really going to go out and solicit, that's a whole nother ball game and a whole nother campaign. But I'm just laughing because we run into this even just internally, because we're not all in the US. And we found out recently, we had someone in the Virgin Islands for a little while, the US Virgin Islands. They can't see it either because that's not considered, it's not one of the states, it's a territory. And we have a full-time person in Puerto Rico also. A ton of people have gone there for the tax jurisdiction and the weather. And it's just fascinating. And then CoreConnex won't even allow us to share data with those people, because they're not in the continental US. They won't even send the daily reports to them, even though it's got no social security number, no nothing. But CoreConnex is just like, nope, wall's closed.
Hey, so, you brought up something, though, a friction point when you talk about the data capture that we need to do up front when it comes to the invest, and this is the tech side. So we know that as an accredited investor, they need to validate their accreditation, and I think I won't overstep my legal skis, nine potential attestations associated. I think that's what we put on our InvestTech, where it says, hey, I got a letter from my lawyer, my accountant, my authorized financial A, B, or C. And and the way that we work from a tech perspective is to try to take out friction so that investor, okay, I'm making a commitment to the investment. I'm not approved yet, but I clicked on the box that says I'm going to get a letter from my lawyer. Now, somebody has to collect that later on. Within the platform, it's either the issuer or a broker dealer logs in and says, hey, I need to make sure that I'm going to get that documentation from Peter, but I'm 9/10 of the journey there. I've made my $50,000 investment, and geez, you're not going to let me have what I wanted to invest in until I do something on your behalf. I get issuers that say, can you turn off social security numbers because it's a friction point? I don't want to do any anti-money, we'll deal with the anti-money laundering. From a tech perspective, we can do it all. And from a legal perspective, you're doing a RegD and you're the issuer. We're the technology trying to facilitate and assist you with visibility to the audience. What's your take and what's your experience? Do you get as far as, you're accountable. The issuer or many hire a broker dealer as far as the management of compliance perspective. What percentage of your issuers do it in-house? Maybe they've got a compliance offer versus utilizing a broker dealer in that regard. to assist them with compliance.
I'm going to jump in because it's
Yeah.
quick. We very rarely will work for an issuer without a BD.
Okay.
Yeah, I'm seeing more. I'll say this: I'm seeing more issuers opt to not use a BD on, say, a Reg D, but typically those are issuers who have done a Reg A, maybe done they've used multiple regulatory pathways, and it's not their first rodeo. I would say like a first time issuer on a Reg D without a BD support, that can be a little hairy and questionable sometimes. I'll throw out just in, and I'm speaking more of individual accredited investors. The documentation thing becomes a rub, right? Nobody wants to take the time to go get the CPA letter and all this, right? Like that just becomes a challenge with any Reg D offering at the end of the day. And I would say, just to be thinking about it from a couple perspectives. Number one is, making, and CorkNext does a good job of like, not saying that, yes, you're going to need this, but like you can keep going through the process and provide it later. So you want to make sure that like technically you're not putting that as a hurdle, right? I mean, I think I've seen some platforms that you have to upload it before you complete the investment flow. And that people are going to bail out at that point because they're not going to have it handy oftentimes. The other thing is, there's you've got to expect the kind of IR side, the kind of sales IR side. This tends to be, or if it's a BD, this tends to be the type of stuff they're chasing down, and it's going to be a lot of chasing down and hand holding, and that's just a bit of the name of the game. So it's, that's the documentation is one of the least fun parts, I would say, about one of these Reg Ds, but it's necessary, and it requires some legwork to get it done.
And if they don't have a family trust or something that's obviously going to make them accredited, it's even harder. The lower on the food chain you get, the more arduous it is to get that paperwork done because they've never done it before, or they don't want to reveal anything.
Well, we do a lot of Reg Ds now from a tech perspective, and it evolves. So we go through all the problems, and mark my words, we understand we've had problems, and it's to do with the attestation, it's to do with the paperwork, it's to do with last minute changes to subscription agreements, and all of these things come into play. So my comment is that, good planning, is obviously necessary up front. And we as a tech provider need to continually educate ourselves and be more knowledgeable about all these regulations. Somebody has a question here, and maybe, I don't know if one of you or whether it's, could you elaborate with my RegS ID if capable? Thanks. RegS-ID.
I'm not sure I'm following that one.
I'm not sure either.
Myself either. We would not do a standalone RegS either. So that's just, I'll toss that out there. So
I've never had someone request that, but yeah, I think we'd be in this.
Yeah, we talked, but I think from a legal a legal perspective, you could, and the only logic I could see there is I reside in the US and I've got a very structured pool of investors in a specific country, and I'm just don't want to fly over there. I don't know. I'm just
we've done an international D also, and it was not a problem. It was for a software firm, not for real estate, but it went very well.
Okay.
I'll throw out one thing that just came to mind on pairing the Reg D and Reg S, and kind of some of the considerations there. And this is just kind of a recent memory piece. So oftentimes we run into issuers where they've done a Reg A or something like that, or they're coming into it with some sort of, they're coming into it with maybe some email lists, some prospects, maybe a small investor base, that type of thing. That becomes a challenge in itself when you take on a Reg D, Reg S, because then you've got, think about all your email communication, like going on what we said before, is segmented, right? So, I can't tell you how many times where we get, an issuer, they've got some lists, this, that, and the other. They dump that on us. And of course, there's no indication of what country they came from and things like that. So you start to run into challenges like that. And then it's, how do you deal with some of those existing assets and then start to categorize them by country? There's a number of ways to do it, but I just throw that out there. These are the types of things when you're getting into these raises that, seemingly are minor, but then become a real challenge, when it comes
and what
to
ad tags are even legal in that country.
Yeah. Yep. Oh, you're on mute, Peter.
You're muted, Peter. Peter? you're muted. Okay, he's doing something else.
Thank you both. I suddenly realized that I have another meeting that had just come up, and we're past the hour. And I wanted to. I can close out. You gentlemen can finish the conversation. But I really, every time I meet both of you, I learn something new. I definitely know that our audience had learned a lot from today, and I think there's so much more. So I appreciate all the viewers that we had today. And by all means, reach out to Andrew Korn and Ryan Frank to get more information, to learn more about their firms. You can get that information on through LinkedIn and through the tags here. At the same time, there will be a recap and a posting of this video, and I want to share that with you. So on that note, I have to, we're 8 minutes in. I'm going to have to depart.
It's 4:08. I should have gone as well. So thank you very much,
Thank
Peter.
you all. Appreciate it.
Great to meet you,
all.
Ryan.
Bye-bye.
You as well.
Bye-bye.
Yeah, have a good
Thank
one.